So we're going to go on to our final speaker today. And I'm delighted to welcome Abbie Main to the room or the Zoom. And Abbie, I'm going to hand straight over to you. Tell us who you are, where you work, what you do. And I know you're going to give us a few angles from an investor point of view.
Amazing. So yeah, hello everyone. I'm really happy to be here today. So thank you so much, Claire Marie, for inviting me. It's actually quite interesting because I met Claire Marie at a similar event a couple of weeks ago with Harveen and Hattie, who are also on call today, very much looking at this focus of how can we boost the accessibility for female founders and for female investors in this space. And it's something that I find just so important from the female founders that I speak to on a daily basis, or the contacts that I have who find it really difficult to get into female angel investment. So yeah, I'm absolutely delighted to be here today and to be able to contribute towards making that a more accessible space. Something that Jenny mentioned in her talk earlier really kind of rang true for me, and the fact that angel investment is a team sport and it's about knowing where the opportunities are. So what I hope to be able to do today is to kind of talk about where that angel investment opportunity sits within the wider kind of landscape of investment. What do we mean when we're saying angel investment? But then also to look at, when you find those opportunities, how can you make the decisions around it? What's going to guide you and your thoughts and your feelings about whether it's an opportunity for you? And then perhaps too ambitiously, I've also thought about kind of giving some tips on when you get to that process, what are the things you want to be thinking about to facilitate that. Every single time I do these talks, I forget to give myself a clock. So please do shout at me if I start running
Don't
over
worry,
on time. You've been on it so far, but yeah, it's a serial error of mine. So yeah, just as a bit of an introduction to myself before I get started. So I am a funding strategist at Seedlegals. So Seedlegals, we basically work with founders and investors to make sure that the legal processes surrounding raising investment, preparing to raise investment, and scaling afterwards are as simple as possible and as least expensive as possible. So that's basically our mission. We're currently working with more than 20,000 companies and 10,000 investors. In my day-to-day basis, I basically speak to kind of between 7 and 10 founders a day to understand what they're looking to do from a fundraising perspective, and to give them tips on really how to navigate that process. When should they do it? What things should they do to stand out to investors? And I think that then gives me quite a unique perspective on also being able to see if this is what a founder should be doing to stand out to an investor. This is what an investor should be looking for to be able to size up whether the opportunity is something for them and whether this is a business that they're going to want to go on that journey with. So just to start then and look at the investment landscape overall. So obviously when a company first starts and they've got their idea, there's a few stages that they're going to go through before they get to that phase where they're raising their kind of big VC institutional round. As you go through those stages, so from idea to prototype right through to revenue and being able to show that traction, obviously you're starting with a really high risk. And as you go through that, you're reducing that risk as you go along. Where does angel investment sit in that? So at the bottom of the screen, I've kind of mapped that out against as you're going through that process and as you're boosting your valuation. That's where you might expect to find those investors. So angel investment might start actually as early as the family and friends round. You might get some smaller ticket angel investors coming in on those rounds too, to be able to back that company right from the beginning. But also you're looking at your angel rounds, which is this kind of sweet spot between 100,000 and 300,000, making the most of that early stage SEIS allowance and making the most of some EIS allowance as well. In terms of why that's the area that angels tend to fall into, I think it comes down to a couple of things. So ticket size is one. Obviously, when you're coming in these big institutional rounds, the ticket sizes can be upwards of 500,000, a million, 1.5 million and beyond. So actually, as an angel investor, if you're wanting to put in that kind of 5K ticket, 20K ticket, 50K ticket, whatever it might be, it can be harder to get into those rounds. But actually, more importantly, I think that the reason angel investors come into these early stage rounds where the risk is higher is because typically it's as Jenny mentioned earlier as well, it's not about the financials in so much as the passion and the mentoring and the excitement of being able to go on that startup journey with someone right from the beginning, to be able to show what you know and to help them get to where they need to be. So yeah, you're typically looking at this kind of between £0 to £300,000 as the angel sweet spot. That's not to say that when you're raising more than that, you're not going to have angels, but it might be that you'll have kind of an early stage fund underpinned by some angel investors. And as has already been mentioned again today, kind of as a syndicate. So you're looking at having multiple ticket sizes, maybe one lead cornerstone angel investor and a fewer smaller tickets under that. So once you've kind of sussed out, right, this is the kind of, size investment round I want to be taking part in, how is it that you're actually going to be able to make that decision about this is where I want to invest and this is where I want that opportunity to be? So actually, I had a conversation with one of the Seedlegals co-founders quite recently, and he's a serial angel investor that had a VC background. So I assumed that he would be kind of very numerical focused, really digging into the financials, the traction, the customers. And whilst all of that is really important, something that he said is actually so much of it is about heart and about his gut feeling, and that he'll be in a room and within that first couple of minutes, he'll have a feeling for whether this is an investment opportunity for him. And he then articulated this in terms of when you're looking at the investment opportunity, it can be so difficult early stage if you're talking to someone who is an idea phase or who's perhaps just testing the first iterations of that product. It's really hard to back that with quantitative data. So actually what you're looking to do is take some qualitative data and transform that into some sort of quantitative metric. So for example, you might take a series of questions or a series of things that you're going to place importance on, and then use a score on that to assess, right, actually, this isn't, this is how risky the business is. This is how much credibility I believe in the financial forecasts. So you can take those qualitative questions and then put them into more of a quantitative scale. So what are those areas that you're going to be thinking about? Well, the first thing, the best place to start is the problem. Do you understand the problem that's being solved, and is it solving that problem? Do you think this is a problem that people have had or will have? Do you think it's a problem that the founders have been through and believe that there is enough there of an opportunity for it to need to be solved? Then you're looking onto the product. Does that product actually solve that problem? Does the product exist yet? If it doesn't exist, how is it going to exist? Is there a CTO on the founding team? Is there an agency that they're going to be working with in order to develop that software? You need to have a roadmap for how that product is going to be created and also continue to be iterated over time as it scales. Then you're going to look at the market and the opportunity size. Do you think, is there previous track record, maybe through some alpha and beta testing of some customer traction? Is there kind of enough traffic? Is there similar opportunities, similar competitors that can help you to decide if that opportunity exists and is therefore something that you'll want to be part of, as there is an opportunity for that to scale? This is probably the most important one when you're looking at early stage investing, but looking at the team side of things. When you're sitting in a room with these founders, you need to decide, are these people that I want to work with? Do I believe that they're going to make this journey exciting? Are they going to be able to take this in the direction that I want to go in? You can look at things like their background. Have they worked in this industry before? What's their education or previous careers? But you can also just look at the skill set. If this is going to be a business that over the next 6 to 12 months needs to be focusing on sales and building out the marketing materials and launching some PPC campaigns, you need to be thinking about whether the founding team or the founders themselves have the skill set to be able to drive that and take the business to where it's going to be with the money that you're helping to invest. Financials is a tricky one because, as I say, often in early stage investment, angel investment, there isn't necessarily a reliable set of financials. So it's more looking into the forecasts. When you're looking at a financial forecast, you're going to weigh up, is this something that's actually not showing enough ambition? Is this too small an opportunity and have they not sold it very well? If they're not going to sell it well enough to the investors, they're probably not going to be able to sell it well enough to customers as well. So it's looking at the ambition that founder presents, but you also then want to qualify that with, is it realistic and is it achievable? Because otherwise you obviously need to be able to see that it's going to get there. And one of the biggest things when it comes to that financials perspective is looking at the valuation of the company. So I know we've kind of spoken already, and the 15% figure is flying around, and that is absolutely where that should be. But what the company presents their valuation as can also give you a good insight into that founding team and the credentials and where the business is likely to go. You don't want a valuation that's too low, which is showing that they're potentially happy to give away too much equity, to be diluted down, and to kind of restrict the opportunity for that company to grow through more investment opportunity later. But you also don't want that valuation to be too high, and then there end up being the chance of a down round that could affect the price per share, and that again can show this kind of negative trajectory of price per share in future, which will off-put future investors too. So yeah, it's looking at those financials, believing, using these other things to assess how credible those financials are, how risky those financials are, how not risky those financials are, to help you to arrive at that conclusion. And then the final thing is the operations. So the biggest part of my day-to-day is helping founders to understand that there are certain things that they can do to make sure that they stand out to any investors and to show that they've got their ducks in a row, that this is an opportunity to be in. So to just touch on that, you can kind of break this down into three main areas. So obviously you've already seen the pitch deck, you've seen the pitch, you've seen the founding team and their backgrounds, but from a documentation perspective, what else have they got in place? Is their company's house in good check, or are they currently one share at £1? Have they got, you know, an existing cap table which shows that they've been realistic with the equity that they've given away, or that shows that they have taken care early stage to protect that company in the way that it can grow in the future? You want to look at things like founder agreements and IP assignments. These are really, really important measures that protect both the founders and the investors, and it's something that you should see as kind of an absolute necessity before actually making that decision to invest. The founder agreement being something that shows that relationship between the founder and the company and the promises they're making from a role perspective, from an equity perspective, and the IP assignment being something that shows that the product they've created or the materials created around it aren't going to be taken away by one key team member, but that it's actually owned by the company that you're investing in. And then advance assurance. So kind of explained earlier what SCIS and EIS are. Advanced assurance is the first step in that process. So you can go to HMRC and you can find out whether you're likely to be eligible. That's a non-required step in order to get SCIS and EIS. But as an angel investor, you might be wanting to think that a company who has gone through the process of applying for that and giving you that credential, giving you that reassurance, again, they're doing what they need to show that you're the type of company they want to work with. And then when it comes to the deal, the biggest thing that I would say as well is looking at terms in advance. If a founder is able to show to you that they've got their term sheet prepared, that's stellar. That's showing that they're a founder that knows what they're doing, they know what they want, they know what they're asking you for, and it's going to be an easier conversation for you to work out with that person how you're defining the relationship between you. Are you going to be a more hands-on angel investor? Are you going to be a step back? What are the definitions around this funding round that help you to decide whether or not you should invest? So I think, Emily, I'm running out of time, so yeah, do let me know.
30 seconds for what, well, just so we can take some comments or questions.
Sure. So yeah, so I guess my final kind of thing is, once you do get into that deal stage and you do start those conversations, basically you're looking for economics versus control. Are you getting good return, but are you also getting the right say in the business that's going to help you to have that mentorship role? I folded here some of the kind of typical terms that are quite hotly contested and negotiated on. So you're looking at your valuation, vesting schedules, investor consents, what rights do you have to veto on, and also looking at that board composition. So yeah, apologies that I've run out of time, but I'll share my slides afterwards, as I've got some data on it that can be quite interesting to see.